Welcome to FreightWaves today. It is Monday. It is perhaps after the biggest nuclear judgment in history. The whole weekend, I think, I talked to a lot of brokers over the weekend. I think that a lot of them were shocked at the size of the judgment, as well as what this means for them and the industry. What are your thoughts, Julie?
Yeah, agreed. To me, I still can't really wrap my head around how the judgment or how the verdict called that driver and employee of C.H. Robinson. So I'll be interested as more is released and more court documents come out and more research is done on it, how they came to that decision. But certainly, all brokers are on notice and sort of the same target that large asset-based carriers have always had on their backs will now be on brokers as well. And I think it's having deep pockets, protects you in some ways, but certainly makes your target.
Well, I think you know this from U.S. Express, is that if you're big, the plaintiff's attorneys are always looking. They know there's big pockets, and that's very different than if you're a small broker. C.H. Robinson is the biggest. In a situation like this, that hurts them.
Yes.
I talked to somebody over the weekend who's been around this industry for decades and says the issue is that brokers now play such a significant role, and the majority of the profits, well known, the majority of the profits in trucking go to brokers. And because they play such a significant role, is that there is a perception that, look, at the larger asset carriers, the big trucking companies have been on the hook for many years, that basically plaintiffs' attorneys know that's where the money's at and are going to use it. So as you talk about being big is a huge advantage. It can also make you a massive target.
Yep, agreed. I mean, and ultimately, in any verdict like this, it's not just the cost of the judgment, which will roll to whoever can actually pay it, right? But also the attorney's fees and the fact that this is going to be the first one, they're going to keep coming and keep
millions
coming.
of dollars.
So much money in fighting these. Yeah.
Any lawsuit that if you're ever involved in a lawsuit, particularly one that has such a big potential outcome. I mean, we're not talking about a very small contract dispute where the damages are $100,000. You're talking about the potential of a lottery ticket, as we've seen. And I think this is going to attract. I think the biggest issue is, frankly, this is going to attract far more plaintiffs' interest in the brokers as targets than perhaps otherwise would be. I mean, this is the largest nuclear judgment in history of an operating company. There was one that was $900 million. That John Kingston reported that was in Florida during COVID. The defendants didn't even show up to court. 900 million was a meaningless number. This was actually one that was litigated. A little bit of information. Again, we're still researching this, but conversations about Lupus Superior, the company that was in question, about potentially has the markings of a chameleon carrier network. And the issue is if this is the thing that sort of struck me, is if it's a chameleon carrier, and unlike brokers have been taking advantage of this, is the issue that is if they're going to go out of business and you have this joint liability problem, that if you do business with a company that then goes out of business, you're stuck.
You're on the hook.
Because even if you're 1% responsible, then you can be, and we're going to hear about this, and I talked to a bunch of plaintiffs' attorneys and defendants that said this is they didn't say there's a problem, they said this is the reality, is in a joint liability state, that even if you're 1% responsible, even if you had only a tiny bit of responsibility, if the other co-defendants do not survive and cannot pay it out, and are chameleon carriers that are likely going to go out of business, you could be stuck with the whole thing.
Yeah, I think this whole thing creates more pressure for small carriers as well. We're seeing the barriers to entry continue to rise. We're seeing small carriers leave the market with all the other regulatory issues. And now with these legal issues, if I'm a large broker, I'm going to be even more and more and more careful with who I'm tendering freight to. And if they are financially viable, what their insurance levels are. I don't know that minimum $750,000 liability insurance policy cuts it anymore.
$750 is not going to do enough.
So I think these are going to create massive changes in all of that.
I mean, a lot of it is, and we've said this before, it's not what you did or didn't do. It's not what you did or did not know. It's what you can convince a jury that you should have done or should have known. That's a very different set of, and it's largely an emotional driven conversation. We're going to talk about this story and we'll continue to talk about it, but obviously this is something that's going to really change. I mean, I talked to some large brokers over the weekend, big companies, and they were just absolutely utter shocked about this. We've been talking about this since the Montgomery judgment. This shouldn't shock anybody. This is going to happen. I mean, like this from US Express is like, you got a big target on your back.
I think the dollar amount is what's shocking.
It is shocking, but I don't know if you've been around, if you followed FreightWaves coverage, we've been talking about 80, 100, 500, the Wabash lawsuit, the judgment, the Warner judgment, the QXO judgment. I mean, QXO, we're not too far off from the QXO incident that happened. The jury decided at the original trial that QXO, the Beacon, I think it was Beacon Roofing, was not responsible. But then in some weird technicality, or the driver wasn't responsible, no, the company wasn't responsible, but some weird technicality on appeal, they ended up awarding them $84 million. It's absolutely insane.
And I think the thing that's even more interesting, we've talked a little bit, and I know we need to get the headlines, but we've talked a little bit about this in passing, is when it does go to a jury, when it does go this far to where it is litigated, carriers certainly don't have sympathy of the jury. I would imagine brokers have even less.
It's
right?
funny you said that.
There might be some sympathy for the driver or for the carrier saying we're doing everything we can. We're providing this necessary service that keeps the economy going. Like you can create some level of that. I don't know how a broker does that. They're just making money off the transaction. Like how do they sell that to a jury?
It's funny you said that. When we had our fraud summit, it was right after I think it was like 2 days after the month. And it was a conversation that took place at the summit where someone said, look, juries are far more likely to have sympathy for a trucker or a trucking company because they have people in their family that are truck drivers. Perhaps they know someone who owns a trucking company and they know that this is hard work.
Yep.
They're far less likely to be sympathetic or empathetic to a broker who is simply making money. And that is a problem in shared liability states.
Absolutely.
Is that ultimately the jury is going to make the decision, and broker culture, that freight bro culture of donging because you made a lot of money, the rips. Look, I was a part of the early days of the rips of the day.
Being the carrier rep and being on, let's say you're on the stand and them saying, well, how are you paid for this load? How are you incentivized? Well, I was incentivized.
How much money? So you have an incentive to drive the cheapest.
I think incentive plans for brokers are going to have to change as well.
Of course they are.
Compliance and safety and all of that.
Safety is going to have to be somehow in that factor. And did you do the qualifications? How do you determine what a safe carrier was? If it's no longer satisfactory rating, how do you determine it? We have a lot to talk about. Let's get to the headlines.
We kick things off with a courtroom decision that sent freight brokerage stocks tumbling. A Dallas County jury handed down a compensatory damages award of approximately $604 million that sent freight brokerage stocks versus Lupus Superior. A Dallas County jury to most likely compensatory damages award of approximately $604 million from a 2021 crash that killed 3 people and the employee driver structured to most likely fall on C.H. which Robinson had hired to move a load of beverages stems from a 2021 crash that Wall Street reacted Friday with a broad driver of carrier C.H. Robinson fell $19, which Robinson had hired to move a load of beverages from to 186.50. Wall Street reacted Friday with a broad sell-off of 210. C.H. Robinson fell $19. RXO dropped 7.7% to 186.50. And Landstar declined 3.68% just 2 days after hitting a 52-week high of 200,500 finished margin. RXO dropped 7.7%.
All right, I don't know what happened, the audio, but that was...
But,
it was a weird thing.
Yeah, more about this verdict and the impact on stocks. So it talked a little bit about that. C.H. Robinson fell 19%, RXO fell 7%. So the market is reacting.
Market is definitely reacting. We're going to continue to react to it. We'll try to fix the audio on our, but it feels like the headline is all about this. Right?
Yeah, and then we just did the other headline, which is ocean rates are elevated. And we talked about that note. And I pulled a graphic where you can see in Sonar what the ocean rates from China and really Asia into the U.S., particularly West Coast, are doing. And you can see per 40-foot TEU. I mean, it's insane. I mean, you can see that what the chart does, how quickly those are rising. And then the other was always a story about fraud, right?
Yep.
The theft of cell phones and how an organized
hundreds of millions of dollars. We have a lot of big fraud stories.
Yeah, it was 1.5 million in targeted cell phones being stolen. So
There was a story this weekend of something like $100 million in cross-border drug trafficking.
In the bananas, that was insane.
Yeah, absolutely insane. Well, our first guest, Dennis McCaffrey. I've known Dennis since the first days of what is now RXO. Dennis was a part of a company called Segments, which was a bulletin board traded stock that then became part of XPO, that ExpressOne and XPO. So we're going to talk a little bit about the history of this industry. Let's bring Dennis in. Dennis, how are you, sir?
Hey, Craig, great to see you.
You're the SVP of Enterprise Sales at RXO. I've known you for decades. Back to the old St. Joe, Michigan, or Niles offices up there at the old ExpressOne. Would love to get the history of your career and how you ended up in this industry.
Well, Craig, when I got out of the Marine Corps, I was looking for a job. I was in college and ran into a buddy of mine who was at the time starting a small brokerage operation and trucking operation. And little did I know when I took that job as I was going back to college that my whole career would then end up being that. And through a series of events, that company was acquired. And then through another series of events, that company wound up acquiring ExpressOne, which ultimately got acquired by Brad Jacobs, and the rest is history. So my whole background has been primarily in the sales role and a commercial role. I've been primarily customer focused and growth. When we first met the ExpressOne guys, I think they were around a $20 million company, and we grew that to about a $175 million company. Early days before we met Brad, and that's when I met you, Craig.
Yeah, I mean, it was early days. Mike Welch was there. Mike Welch, I knew when we first started working with ExpressOne up in Michigan. It was the National Logistics Management, the NLM business. Yes. We put somebody on site, a guy named Chris Harlambopoulos, which has the best name. The dude was bigger than life. By the way,
Big Papa.
The Harlan Bopp has thinned out. He's a fan of the show and good dude. But he was on site, and the idea was that we would use U.S. Xpress's Express Direct capacity to provide on-demand and really guarantee capacity, but not guarantee a price. We were one of the first carriers to take advantage of that. Frankly, brokers at that point were more backhaul and really didn't see the opportunities. ExpressOne was one of the first companies to sort of realize that they could use the truckload assets to provide on-demand capacity. You were right there at the ground floor of that. What was it like seeing, the Welches take this business? By the way, rest in peace, Mike Welch. Take this business and build it into something, and then sell into or have, a bigger than life Wall Street investor like Brad Jacobs step in and use that as a platform what was that like really in the early days?
Well, I think, early days, the one thing we recognized, Craig, right away was that, hey, this business is scalable. However, the expedite market was fairly small, especially back then. I mean, there was a very limited number of carriers that had Qualcomm capabilities or real-time track and trace, and which was very critical for line down situations. Majority of the business, just as it is today, was related to the automotive sector. But the one thing we recognized, the reason we partnered with your company at the time was, you couldn't have a truck available within 90 minutes of reaction time throughout the entire nation. I mean, even if you had thousands and thousands of trucks, you just couldn't supply that demand. And there became a bigger demand for truckload quantities versus the cargo van quantities. So partnering with you guys and other companies allowed us to grow the scale of what was then ExpressOne. And again, Mike and his brothers were just wonderful leaders. They had essentially was a family-run business, but that was public. And they had a great vision of growing that business from the expedite side. But then when Brad came along, it was like, look, this is a very fragmented industry. We can grow this well and beyond. We can use some of the capabilities that we learned in the expedite business as far as just in time, one of the appropriate topic for today, extreme carrier vetting and making sure that we do things the right way and deliver to our customers from a time critical nature. Taking some of those lessons learned and applying those in the brokerage space, I think, as we go today. And just little known fact, we still own the NLM platform. It's our managed expedite platform. we still are probably the largest single transaction expedite provider today. And we're looking at ways to leverage that technology now to serve the spot market, which is obviously a massive deal right now.
Yeah, NLM, I remember you guys at the point, ExpressOne did not own it. It was at one point an independent company, sort of a .com enterprise set up by the Automotive Logistics Network, sold to Landstar, and then Landstar ended up selling it to XPO. And of course, it's lived there. But, it was interesting when I think back to those days. I was in my 20s. It was, early 2000s.
You both were a lot younger, Craig.
What's that?
I said we were both a lot younger then, Craig.
We had hair back then too.
Yeah, we had hair. Yeah, or different color hair. Yeah,
this business is brutal. But Dennis, I think the thing that was really, brokers were not playing in the on-demand, last-minute business. They were mostly either backhaul, doing loads that provide carriers, American backhaulers model of finding freight to load a carrier on a backhaul lane. Or really, we're kind of, helping do optimization. Managed trends was starting to become a thing. Companies like Transplace, the Menlo Logistics, which is a part of RXO, was sort of taking on a role, but it was still a very cottage industry. It really wasn't until since the financial crisis in 2009, we saw this massive growth of brokers playing primary routing guide. ExpressOne was very early in that business of using sort of an in-house brokered model to provide relief. I mean, it was instrumental in the growth of what's now RXO.
Yeah, 100%, Craig. I think the big thing that changed was technology, obviously. In the early days, from a technology perspective, we had to utilize owner-operators, Qualcomm technology outfitted on all the trucks. There wasn't the macro point. There wasn't other abilities to track cell phones. It just wasn't as accessible to the wide range of carriers, especially smaller carriers. But as things took on with the development from an XPO, now RXO perspective, our RXO Connect platform, and then connecting with carriers so that we can provide that real-time track and trace. The other thing is we have our Flex Fleet, which is we have drop and hook capabilities throughout the United States and Mexico and Canada as well. Allows us to have more of an asset feel as a broker. Which I think is something that has changed dramatically in the industry since I've been in it, is that brokers acting more like assets and being relied upon for just-in-time transportation, like we're talking about, and also high-value transportation, high-value product transportation.
Yeah, I agree wholeheartedly with that shippers really love it when you can provide that asset-like service with the flexibility that a broker can provide from a network and service standpoint. So as we talk about RXO's business today, what would you really call the core of it? We've talked about all of the different things that you guys all do as managed transportation and brokerage and last minute, certainly capacity now. What would you call the core, and what are you most proud of?
Well, we're proud of everything we do, but I think we're the third largest freight broker. We're very proud of that position that we have, we're also one of the largest managed transportation providers. We manage a little over $4 billion in freight under management. Our managed expedite platform actually falls underneath that business unit as well. We also offer dedicated transportation and dedicated contract carriage, which from an asset perspective, which is actually gaining a lot of traction right now at this type of market. Customers want to lock down capacity and looking at dedicated contract carriage a lot more closely right now. But our last mile division is the largest big and bulky last mile provider. We do well over 30,000 plus deliveries to homes each and every day. And that's a wide ranging business. And now we're looking at connectivity between leveraging our last mile hub network with our LTL TMS to offer big and bulky transactional LTL services, which is pretty exciting. And a lot of retailers and customers are very interested in that product. So we really have a wide breadth of servicings and service offerings. And that's kind of what I think our competitive advantage in the marketplace is compared to some of our peers. We can really help customers, especially large customers, understand, solve complex problems, complex challenges that they're having, and be more than just a truckload provider.
So Dennis, we've heard a lot. I feel like we've been talking a lot about last mile recently. What are you seeing as far as demand there?
Well, it's a little bit, demand is a little bit soft right now overall, because I think if you look at like appliance sales are down, from a year-over-year perspective, and that's a big driver for us and big and bulky last mile network. However, last mile overall is still a very high demand product. We have over 70 plus last mile hubs across North America. We're working with just all the biggest, largest customers right now in that space. And I think, we're having ongoing conversations about how we can get more and more creative with those services, how we can get more and more efficient and leverage technology to maximize stops, maximize utilization and reduce cost.
Dennis, I'd love to sort of take us back through history. So Brad Jacobs comes in. By the way, I had stock in XPO, ExpressOne at 75 cents. My broker, which I'll never forget this, it got to $1.25, and he talks me into selling it. He also talked me out of, this was in 2009, of putting a put on Citibank right before the financial crisis, which I would have made a lot of money on, but neither here nor there, money that's not done. But this guy, Brad Jacobs, comes in, who was an unknown commodity, had been successful in waste management, in rental, the rental business comes in. Could you have envisioned what XPO would become and RXO would become today? I got to imagine back in 2012-ish, I think, when Brad Jacobs first arrived. I actually had drinks with Mike Welch right after the Segments deal. And I'm like, dude, what are you doing? You're selling into this public shell of a company, this bulletin board stock. You had a plan, but then Brad Jacobs comes in a couple of years later, obviously one of the most iconic founders and entrepreneurs that's ever been in logistics. Certainly would be in the Hall of Fame. What was it like in those early days?
Well, Craig, and I'm sorry about your transaction, because I think you probably would be just flying your plane and
I would be doing something else. So it was God's mission to make sure that I had to have a job and do some real work. So maybe that's what this is. Every missed opportunity is a door open. But Dennis, what was it like?
Yeah. So I mean, look, Brad comes in. It was actually 2011, and Brad comes in, and he initially first told us, "Hey, we're looking to be like a $4 or $5 billion company." We thought that was crazy, because we were only about 175 million at the time, and it was kind of beyond all of our grasp. However, we looked at the history of Brad's, what Brad did with United Waste, United Rentals, and we all realized, gosh, he's certainly the guy to do it if anybody can do it. And after you quickly get to know Brad, he is just has the highest work ethic or strongest work ethic of anybody I've ever met. Incredible vision. And he's just really a very focused individual. There's no one I've seen that's more focused once he gets a mission on what he wants to accomplish. And he surrounds himself with incredible talent. I think I know a lot of our alumni from an XPO perspective are scattered throughout the industry doing great things. And Brad has a great keen eye for talent. He always surrounds himself with A players. And then everyone gets on board and goes after that mission. And he's just relentless, relentless after that mission. We did 17 acquisitions in 6 years. To say that we were all drinking through a fire hose would be would be an understatement. We used to joke around that we're building the plane as we're flying it all the time, and but it was an incredible time, and it was certainly chaotic at times, but amazing that Brad and the leadership team, and which I was part of at the time, was able to keep everything on track. And one of the things we forget about with the acquisitions, all the acquisitions we did, we had incredible organic growth during that time, double-digit organic growth every year, even with the incredible acquisitions and the synergies and the cost savings that we drove and the incredible shareholder value. We had really, really strong run on organic growth because we were able to take all those services, put them under one brand, and make them very attractive for the customer base out there, which at the end of the day, you have to sell something. Is what I always say. Nothing happens till you sell something, Craig.
Yeah, no, it's true. I mean, I remember the early story of XPO was that you were going to roll up freight brokers. non-asset freight brokers. That was sort of Brad's vision that he laid out to Wall Street. And there was a massive pivot when he bought Conway.
Correct.
What was the driving force to go from, hey, we're going to roll up brokerage, which I think in hindsight probably wasn't as attractive as owning an asset-based operation in a roll-up business. What was that like? Like, what was the evolution? When did that sort of become obvious that was the direction? Because assets just were not on the radar at the time that he founded what is now the XPO network of companies.
No, you're 100% right, Craig. When I first met Brad, his vision absolutely was an asset light model. And we did the 3PD acquisition, which got us in the last mile space. We did the Pacer acquisition, which again you could call asset light because it was mostly owner operator contractors on the drayage side and owning some containers. And then you had the New Breed acquisition, which was warehousing, and I think that led him to the Norbert acquisition. And when we did the Norbert Dunter-Sangla acquisition, sorry for my poor French there, I think what Brad realized at the time was when he met some of Norbert's customers globally, and the position that they had an asset-based trucking division that was located in all of Europe. I think XPO still owns that division, which handled LTL and truckload. I think he saw the seat at the table that that Norbert had with their customers, offering that wide range of services. And I think we initially had some discussions with Menlo on acquiring them because that would have fit perfectly in the portfolio from a managed trans perspective. But then when you looked at the Conway was part of that acquisition because that fell underneath that umbrella, I think we were a little reluctant. But I think when Brad saw that the opportunity with Norbert and the opportunity to grow market share and really deliver shareholder value, I think that's where we jumped on it. And then I led sales on the XPO LTL side, after the Conway acquisition for a couple years there. And, it was the biggest driver of EBITDA. And, Mario now has taken that to all new heights and done an incredible job with XPO. And I'm a shareholder there, so keep going, Mario and team. They do an incredible job. But I think, the big thing is you could deliver a lot of shareholder value. That network was, we could be maximized from a utilization standpoint, drive the yield and volume through that network and really drive a lot of cash flow and a lot of EBITDA. So I think that was really the big pivot. The shareholders reacted. I think at one point they were a little pushed back a little bit, but I think they were rewarded in the end.
Yeah, I remember it selling off, I think, when there was a realization of that, hey, this is a pivot from brokerage. But one of the more interesting things was CFI was a part of that business at one point. If anyone wants to know about whether truckload, asset-based truckload is an investable asset, the most prolific investor in our industry, the only asset that he sold off was CFI's truckload business. That should tell everybody. Was that a surprise to you guys, or was that a part of the original plan?
No, I don't think that was original part of the plan. I think it just worked out. I think similarly to the Pacer when we spun off what was the XPO Intermodal to now STG. I think there was just a good opportunity to sell it in the market, and it really neither one of those, or I should say the CFI at the time, it just didn't fit as well as the other acquisitions from a truckload standpoint. I think when you have a large truckload brokerage, I think sometimes there could be an overlap in services there, and it just wasn't crystal clear to the customer the value you're providing. And as the operating ratios on those is not as attractive as some of the other modes. So
Dennis, I know it painfully well. We know it painfully well. I know it painfully well. My dad built a $2.5 billion corporation. Julie was an executive there. And man, when you're talking a couple % at a good year, it's brutal. And these other businesses are far more attractive. I mean, LTL, managed trans, just so much more attractive on return on assets, return on capital. So no surprise, but it tells you everything you want to know about. Because there was a question I remember when XPO, when Brad was rolling up stuff, would he roll up the truckload industry? I think certainly my family included, every CEO of a publicly traded truckload carrier or large truckload carrier was hoping he would, because he was paying at the time top valuations. In hindsight, looked cheap, but at the time, it's like, yes, let's go. Maybe he'll sell it. He'll buy these things for 12 times.
Yeah, I think the asset light model, the interesting thing that also, from a pivot standpoint, when you look at the brokerage networks and the companies that were operating brokerage, to roll up a bunch of brokers was going to be a bit of a challenge as well, kind of going back to our Conway discussion, because when you look at brokers, they when they overlap, you often have a lot of the same customer base. So there wasn't sometimes a whole lot of value. Now, it was interesting with RXO, when we did the Coyote acquisition, we actually had very little overlap with those guys. I think roughly 30%. We were, RXO was very heavily interested in, or heavily invested in, the automotive sector and retail sector. Retail sector, I think, comes from having that connectivity on the last mile front. Our customers look at us, you tend to build those relationships organically through kind of the shared service platforms. But when you look at, when you look at the Coyote acquisition, again, we also only overlapped, I think, roughly 30% even on the carrier footprint. They had a whole different carrier footprint than us. So that was kind of unique in the brokerage space, but very difficult to overlap two brokers and get the value that you want. So I think that was part of it. And then on the asset truck side, I think it would have been interesting maybe to go after some more dedicated contract carriage or possibly some other assets that are very maybe niche, but going after full truckload business, I don't think we wanted to compete in that space.
So Dennis, with all of these acquisitions and this amazing enterprise offering and all of these different service offerings that you all have, how do you communicate that with your actual customers to find the fit in what they need within your organization?
Well, I think, Julie, we have to listen at the end of the day. You really, what I try to do is sit down with customers and understand their supply chain. Try to understand what are the biggest challenges they're dealing with. Where are they getting underserved? What does the next 12 to 18 months look like them? What's on their future radar? And then we try to go back and solution something or design something that'll fit for them. Sometimes it's a very small service that we're going to offer, but small but valuable service, like in the case of, say, Expedite, for instance. But I think it's really more about listening and really trying to understand the different parts of our customer supply chain, rather than trying to just, as in the old sales world, show up and throw up about your services. Because at the end of the day, we need to give them services that fit into their network and provide them value.
All right, Dennis, final question. So what do you see happening in the next 12 to 18 months, both with your business and then in the market? The freight market?
Well, I don't think it's going to get any easier. I mean, I think with the regulatory situation that's going on in the market right now, I don't think the government's going to slow down on the capacity exits. So I think if the capacity is going to continue to get tighter, if we get any volume spike whatsoever, then it's going to be a very big challenge. But we're here we work in all markets. We work in the downturn. We work in the upswing like this market. And we try to figure out the best ways to help support customers, no matter what the situation.
Well, Dennis, thank you so much. Great to see you. We'll have to have you back to tell us more of these war stories from the great archives of the RXO's lineage. Really appreciate it, Dennis. Man, what a great story. Like in terms of just the history. I've known Dennis for 25 years.
And what you would see and learn from every one of the cultures of those organizations. Different organizations. The way that they were doing it and then what they operated really well that you could implement versus what they weren't doing well.
I mean, Drew Wilkerson, the CEO of RXO, his boss has talked about the fact that this is what we're seeing right now in the market is the most transformative time in history since deregulation. And look, as the stories that we keep pumping, the stories that keep coming out, no doubt that that's the case.
Yep.
We'll be right back after these messages. We're going to talk more about the C.H. Robinson lawsuit in our Sonar update. Stay with us.
The drivers, dispatchers, mechanics, and crews who keep the world moving deserve tools that work as hard as they do. That's what Samsara builds, technology for safer, more efficient operations, made with the people who do the work. Samsara, built with operators for operators. Learn more at samsara.com.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Welcome back. We are going to dive into the Sonar data with today's Sonar update.
It's the weekend after the biggest ever nuclear judgment against an operating transportation company. The $604 million nuclear judgment that involves C.H. Robinson. Now, C.H. Robinson is a part of the overall group. It's not solely responsible for it. But if you look at the way the court system works, if one defendant can't pick up the bill or pay the judgment, then the other ones must. And so this is a very interesting set of issues that's going to involve a lot of different parties and a lot of different and substantial impacts. So what we're talking about here is a accident that happened. There was a six car pileup. The truck driver actually passed away. And basically this motor carrier, Lupus Superior, ended up basically in a situation where it's unlikely to pay out the judgment. And so let's talk about where we're at. I think there's a lot of things here to discuss. One is, this is just the start. We're going to see a lot of these judgments come about over the next couple of years and many times over. The fact is that brokerage is at least a third of the all truckload freight handled in the for hire market. Brokers handle at least a third of it. So just in terms of sample size, at least 1/3 of all accidents and lawsuits are going to involve a broker. And plaintiffs' attorneys have figured this out. They are paying attention to the market. They're watching the market, and they're looking at how can they go get the biggest dollars. In fact, Matt Leffler says they have a fiduciary obligation now to their clients, i.e. the plaintiffs, to go after brokers. And so you're going to see these lawsuits pile up. We're not just talking about the judgments, but we're talking about the legal fees to defend them. And when you talk about years of lawsuits and appeals, you're talking tens of millions of dollars that are going to be involved in just defending these lawsuits. So brokers are going to have a significant challenge of just navigating this. I've talked to a number of brokers over the last couple of days, and what I've heard is that plaintiffs' attorneys are bypassing the smallest operators when there's an accident and going right to the broker, simply because that's where the money's at. I've talked to other brokers that are just trying to figure out what this means for them. Some of them are changing their underwriting criteria to look for bigger motor carriers. Two reasons for that. One is that motor carrier has bigger insurance policies. The second is if something happens, the broker's not likely to just fade away. Remember, if you are dealing with a motor carrier that is non-compliant and just shuts down a chameleon carrier, then the problem is when there is a judgment against that motor carrier, you're on the hook, because that company may not have active insurance or may shut down the next day. As a chameleon carrier, you're on the hook if you're a broker and use them. So this is a big issue. Reality comes down to the fact that a lot of brokers, the incentive structure was set up to benefit them in terms of maximizing margin. This is the classic way of, you get your rips, and therefore when you maximize margin, your incentives is to find the cheapest price motor carriers in the market. Compliance has an expense. Compliance has a cost. The larger enterprise motor carriers were not taking the same levels of risk that the smaller operators did, particularly these chameleon carriers and these low quality operators were often far cheaper than their fully compliant competitors. And therefore, brokers had an incentive to go hire the cheapest motor carrier. And that's why we've seen things like Super Ego and the lawsuits involved in C.H. Robinson with those. We've seen this Lupus Superior, which reports suggest that it also may have very similar sort of makings of a chameleon carrier network, as we've seen in multiple different lawsuits. Those carriers are definitely not making the same levels of investment in safety, compliance, technology that you see with the larger enterprise motor carriers. Quotes in terms of what I've heard is a lot of the brokers have played as riverboat gamblers. They're willing to take the risk. Again, it's about short-term incentives. And if you think that isn't driving it, go look at Wall Street. As we saw during the financial crisis, even the largest firms, some of the most established and reputable financial firms, Goldman Sachs, Morgan Stanley, Bank of America's, Merrill Lynch, so forth and so on, these guys were playing fast and loose because the incentives were set up to allow them to play fast and loose. That's what brought the entire financial services industry and created the financial crisis. Was there was very little regulation, and the incentives were set up to basically take advantage of it. So when we think about what we're talking about here in terms of the flash boys of freight, it's exactly the same set of scenarios exist in this market that existed then. Is that ultimately when you have brokers that have created such scale, 1/3 of all freight is handled by a broker, and the incentives are set up to maximize margin, and compliance is not as persistent as it should have been, or certainly will be, then you have a lot of exposure now in the brokerage market. And that's why I think we are going to reach the flash boys environment in trucking. This is going to be something that plays out. The lawsuits are just starting. We're going to see those judgments continue to pile up. Yes, there's going to be appeals that take place. Many of these lawsuits are going to be reduced in terms of judgments, reduced or settled or completely thrown out on appeal. But the fact is that there's no longer a federal preemption, which was the strongest defense that brokers had. And because there's no federal preemption, everyone is on notice. And if you've ever been a part of a large motor carrier that has a giant target that's on its back, I was talking to my brother, who is the CEO of US Express, really right before it sold, and he talked about the fact that in a given year, they could be receiving over 1,000 different legal notices that came in on everything from small fender benders to damage that's done. So, driver runs over, damages a dock door, or driver runs over a lamppost, all the way to major accidents. Is that the problem is twofold. One is the nuclear lawsuits are absolutely massive. The second, and that's a massive risk that oftentimes is hard to navigate. The bigger issue is all of the very small judgments, all of the $15,000 to $20,000, get a lawyer, you have to hire a lawyer in the local county or local city to go file and just deal and navigate the paperwork mess. He said that's the stuff that adds up. And now brokers are going to be subject to those issues as well, simply because now there is no federal preemption. So we're going to see this story continue to evolve, continue to be an issue, and we're going to watch it. I want to talk a little bit about Martin's earnings. And so it wasn't a real bang-up quarter, probably a little disappointing. The question is, why is Martin the number one refrigerated public carrier, the only pure-play refrigerated public carrier, just not seeing the same level of upside in terms of performance that you're seeing in the general over-the-road for-hire market? And it comes back to a couple of things. One is we're not seeing contract rate movements in refrigerated substantially. Like if you look at our data, refrigerated contract rates have not moved in the past year. There's been no forward movement or increase in contract rates in the refrigerated market. Unlike the van market, where you have seen our in-market, in terms of van rate increases, have actually been quite substantial in that same period of time. 19% increase in van truckload contract rates versus a 0% in refrigerated. Now, it's not to say that you're not seeing increase in the spot market. We're up 51% in terms of refrigerated spot rates. Van contract is flat. A lot of the van freight does move by spot, but Martin's business is largely contracted commitment and largely dedicated. It is not getting the exposure that you get. And I think what happened is we had these different periods in time in 23 and 24 where it looked like the freight market was recovering. There was sort of some acceleration and momentum in the overall freight market. Tender rejections increased in refrigerated due to some seasonal and weather events. And I think what happened is that Martin and the other contracted refrigerated carriers just got ahead of themselves. And so this time they've been somewhat reluctant to lock in higher contract rates. And so that's why, frankly, it looks like they're underperforming versus the market. But it does suggest that there will be a lot of operating leverage to come in stocks like Martin and in the overall refrigerated market, simply because things now are very apparent that we have turned tides. And it looks like if you're Martin or other large refrigerated carriers, that you believe that there's a lot of operating leverage ahead of you. Well, I mean, look, I think, Julie, the bottom line is this lawsuit, this judgment is going to be really transformative. And look, I'm a big fan of Michael Lewis's books. He wrote Flash Boys, which talked about the financial crisis, what led up to it, lack of regulation, lack of oversight. And really, when your incentives are designed in a way to drive behavior, which is how brokers have built their compensation programs, sometimes the people that work in those operations are going to operate loose. They're kind of riverboat gamblers, and not true for every person in the business, not true for every company.
Right.
But look, you'd be naive to think that isn't a major issue for a lot of these freight brokers.
Yes, I mean, I think certainly if I were in a position of leadership at one of these, at any large broker, I would be incredibly nervous.
Well, the problem
right
is not, and this is the thing.
Not of what we do going forward. You can fix that, right? You could say, these are our processes going forward. We are going to be incredibly tight going forward. Yep. This is what we're going to do. We're not going to use X, Y, and Z carriers. We're going to set all of these standards in place. What you can't do anything about is anything that's happened in the last 2 years.
or 3 years or 4 years. I mean, this case was 2021, was we were talking off air about what is the statute of limitations. And it's interesting because in involving a death, and it's every state has their own statute of limitations, but you can file suit 2 years to 3 years is sort of the general rule. However, it's from the time of death. So if you end up with someone in an accident and then you end up, they're permanently paralyzed, perhaps they're in a coma, and you've got a couple of years, but with minors, it's until they're 18. And so you can have a situation where a person is 12 when they die.
Or
years.
12, and when they're horribly injured, right? And then when they reach 18, they decide that they want to do something about that injury.
It's a morbid conversation, an unfortunate conversation, but it's one that is going to be a problem in our industry. But it does feel like there's been a pretty pivotal moment in history where plaintiffs' attorneys are going to, this reminds us of the asbestos issues and the talcum powder, those big, massive momentum of plaintiffs' attorneys when they realize there's blood in the water. They're all sharks.
Yeah.
We'll be right back.
Well, we're going to do our highway segment very quickly and talk a little bit about fraud. So 2 major busts this week show criminals are still hiding behind legitimate freight. In Italy, authorities seized nearly 1,700 pounds of cocaine hidden among banana pallets in a refrigerated container shipped from Ecuador. Officials say that cocaine carried a street value of about $290 million. In Ontario, a cross-border investigation called Project Bay uncovered a broker-style operation inside the commercial trucking sector where drivers knowingly moved drugs within otherwise legitimate supply chains. That bust recovered nearly 1.7 metric tons of cocaine, methamphetamine, and opium, with more than $139 million plus 17 firearms. 21 people now face 104 charges. 2 very different busts. Same lesson. Legitimate freight is still a top target for traffickers. Our Fraud Watch segment, Verified, is brought to you by Highway.
Well, Julie, crazy stories. Every day we come in here and it's fraud, it's theft, it's drug trafficking, human trafficking. This industry is by no stretch boring.
Never boring.
Never boring.
True. New things every day. Now we're going to take a quick break and we'll be right back.
Every load you move depends on one thing, knowing who's on the other side. And Highway gives freight brokers the carrier identity tools to verify carriers, secure the load, and book with confidence. The performance guarantee puts up $100,000 behind that promise. Real money behind this standard. No other freight technology company has made that commitment. This is, again, Highway, the standard for carrier identity.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
a couple of weeks ago, we put on the very first driver application shortage hackathon. And we put this contest out. We gave everybody access to Sonar's API, and we had 17 companies that went out and created an application to address the driver application shortage. To talk about that, our winner is Sean Conley, who serves as the Vice President, Director of Business Development at Vantage Logistics. Sean, thanks for coming in. You first of all, let's talk about you've won this. The product is called RateSafe. Let's talk about what that is. But before I do that, for those that don't know you, what is your background? What made you decide to join in this hackathon?
Yeah, for sure. First of all, thanks for having me down. Chattanooga's beautiful. We were just talking about that off air. My background, as you said, Director of Business Development at Vantage Logistics. We're a third-party logistics company based in Columbus. It's Sunbury, technically. We've got offices in Orrville, Ohio, and then Fort Myers, Florida as well. And Adam and Jason, the two partners, when they founded it in 2014, we actually started as a trucking company as well. So I think that helped me in coming up with the idea behind RateSafe too. And what RateSafe is essentially, to put it into one sentence, it helps drivers know when to say no, or in other words, what not to book, right?
So what exactly is RateSafe? You're using Sonar's API. Talk a little bit about what it actually does. Like, it helps drivers know not to book, but what does the product do?
For sure. So to give you an example, take you back like 5 years ago when I was account managing, customer approaches me, hey, I need you to cover this load, right? So then I, at that point, go out to a multitude of carriers and offer this load to them, right? But that individual load means something different to every single one of those carriers, right? And the reason is because they might have different fuel economy, they have different profit and revenue goals, they have different home time expectations. So what might look very good to one driver looks very bad to another, and they should not book it. So RateSafe helps cut through that noise and tell them what they should and shouldn't book in very plain English, right? So it quite literally says take, avoid, or counter. And then also in plain English, it's explaining why behind that. So it's taking Sonar's APIs, which is the backbone of the market analytics within the app, and it's telling them what is a good area, right? What is that rate that you're being offered good? And then also comparing it to that driver's own personalized operating costs, home time expectations, and things of the such.
And the idea, I think one of the insights you had here, and I think one of the reasons that I liked it and that the judges liked it, was the fact that it's not built from a broker's perspective. It's built from a carrier, owner, operator, or driver's perspective.
Exactly.
Which is, running trucks. I like to quote Doug Wagner, who said this. Maybe he regrets it because I've said this a few times. Doug had said at F3 is that most brokers that has worked for him or worked in the industry could manage a truck if their life depended on it.
Sure.
It's a very different activity. Brokers typically are not worried about thinking about the driver's home time, thinking about that. But having been a part of an asset-based trucking operation is built into Vantage, you understood how important the non-rate decisions are. Because I think so often in a transaction, brokers are all thinking about price.
Of course.
And all too often, even carriers, all they talk about price, but there's all these other decisions that go into it.
There's so many more that play into it. And yeah, I think there's always this stigma of brokers and carriers not getting along. But I think ultimately any good broker should want drivers to make good decisions. You guys know better than anybody. I think you talk about it every day, what has gone on over the past 3 years when market rates have driven down to the floor, right? So, and shippers included, shippers should want their carriers to make good decisions, because if you've got a really good driver that shows up on time, that's very communicative, that does the right job, you don't want them operating in the red to the point where they're going to ultimately go out of business, right? So that, from my perspective, if we can add value to the drivers that do and add so much value to us as the broker, why would we not want to do that?
Yeah, and I loved that it was personalized for the driver's home time, what parts of the country they want to go into, what they need to make based on their cost to break even, and how they can do that, not just one load at a time, but looking at it a little bit further along to where they're going to end up and where they would get their next load. So you have a real full-time job. What made you decide to do this, to build this app and to participate in the hackathon?
Yeah, well, this is just a bunch of firsts for me. I've never been to Chattanooga. Building software is new to me. I do it within the walls of Vantage, and I've found success with that. But when I follow you on X, Craig, and when I think you were just initially thinking about it, like we should do a hackathon, and then it turned into Dash, a driver application shortage hackathon, and I was like, well, I'm building software for Vantage, why not? Because I've seen these at other companies, these hackathons, and just personally, I find it neat. So I wanted to participate, and I sat down and thought about what could add value to drivers, and it led us here. So,
well, I think it was actually, I credit Reed Lustalot, who it was his idea. There was a conversation on X. He said, why don't we do a hackathon to improve the lives of drivers?
Yeah.
Of course, I was being a little facetious when we called it the driver app shortage, because I got a lot of hate about the fact that there's so many apps for drivers. But it was a play on the driver shortage, which is always a fun topic.
There's a lot of apps, but they're not all for drivers, right?
No,
or they're not built
are
with drivers in mind.
No,
they're
a
apps
lot
that
of them
drivers have to use for everyone else,
You've got brokers, large fleets, back office, and
track and trace.
Yeah. And when it comes to the driver, oftentimes you find they're just throwing another dashboard or more rates or things like that. But what I found was the real shortage was decision making, right? You have so much data. You guys are the kings and queens of it, right? At Sonar, you have so much data that I love, but I have time to sit there and learn how to apply it, right? For a driver, you want to stay in your lane as a driver. You don't maybe want to become a market analyst. You need decisions. You need them fast. You need them that fall in line with what your goals and expectations are to your own success.
So let's go back a couple of years ago. So you're in middle of a freight broker. That is your career. You're successful at doing that. Did you ever imagine a couple of years ago that you'd be coding anything?
No, not a chance.
Had you ever coded before?
No.
When did you start coding? Like, what was that experience like?
Yeah, for sure. So when we were looking at upgrading our TMS platform about 2 years ago, and I have just always been personally fascinated with technology, so I keep my finger on the pulse of what's new within the market, what can we utilize, things of that nature. And it started with a load tender parser. So I went out and I started talking to multiple companies in that space. I won't name names, but there's plenty of them out there that build out-of-the-box load tender parsers, right? Because I saw that...
What's a load tender parser?
Right. So our customer hands us over a load tender in whatever form that may be. PDF. Yep. So here's my load that I need you to cover, right? And we turn around and we manually input that into our TMS system. So if we fat finger a date or a time, that costs us money, right? Because that's our fault, that we can't push that off onto the shipper, the carrier. So we're eating that cost to reschedule or what have you. So I was like, okay, well, let's try to take out the manual input. Started contacting these companies and learned how expensive it is to purchase a load tender parser from one of these SaaS providers. So I hopped on ChatGPT at the time and just started, you had to copy paste code from back in the day. Which ultimately is not too long ago with how quickly this stuff's moving. So I hit some roadblocks when I came to the machine learning part of it. But at the turn of the year, this year, tools like Cursor started coming out, and I was able to get a lot farther. And then, of course, the improvements in the models overall that you have access to. But that's where it all started. So that was the first tool that I built. And then I realized that I could build an entire suite of tools. And you've had multiple guests on your show that talk about how you kind of have a leg up when you have this domain expertise, right? So I come from this background as an operator, as an account manager. I know what could add value immediately. So it's what AI does is it just lowers the barrier to entry of somebody like myself who can take a concept and then move it into production very quickly. There then becomes their own problems that can come along with that you got to be careful of. But I've also built tools for our accounting department, right? So I'm not going to sit here and ask AI, what does accounting need for a freight brokerage, right? Because it's not that simple. One, it's not going to know. And two, it's not going to know specifically how the accounting folks at Vantage Logistics handles their accounting. So I had to go sit with them for multiple days and learn what they do because thank God I've never had to work in accounting. But that's where I think it gets a little dicey with people just trying to build any and everything. You really have to have that domain expertise to leverage tools like this.
I think it gives you an advantage. The interesting thing is we're in a world where SaaS or software that used to be, you would design a workflow around the software. So you buy a new TMS or accounting piece of software. The workflow, the process is built around the software. Today, I think what you're describing is that the software is built around the human workflow, which is a totally different game.
Yes, that's 100% correct. And in speaking of RateSafe, the reason why I'm here, you start with a UI. I don't think that there's any way around starting with a user interface like an app or a website or something like that. But my goal with Vantage and all the tools that I've built there is to really meet people where they're at, right? I don't want them to have to go log in to another platform. I don't want them to have to go out of their way to do something else, because that's been a primary focus of mine, is to cut down on noise. Because you're right, it's extremely noisy. There's stuff everywhere. There's an app for this and data for that. Like you should be designing tools to meet people where they're at so that they can just operate more efficiently.
Are you bullish on SaaS, or do you buy into the SaaS apocalypse based on your own experience?
I don't necessarily buy into the SaaS apocalypse. I think just like anything else, people really need to spend time with these tools, right? I tried to calculate it just based on how many code deployments I've made to these tools, and it's somewhere in the ballpark of 1,500 to 2,000 hours just since middle of January. So it takes a lot of time to learn how to work these things efficiently. So there's a lot of crap out there, for lack of a better term. There really is. And when I was even trying to think of an idea for this hackathon, there's just a bunch of junk.
There's a lot. It's a race to the bottom in some ways. Harish, who's at Augment, he's the founder of Augment, had a customer summit a couple of months ago. I went, and he makes a point that the vast majority, he's like, I want you to look at your business. And he's like, everyone talks about AI being, dealing with is going to replace the billing clerk or something. He goes, that's the least return on investment. The highest return on investment is software coding. And he's like, frankly, what you can get out of software coding, something like 85 to 90% of the tokens today, according to Harish, are spent on software and engineering. That's where the big value is, because you think about it, everything we do in software is either reducing expense, making things flow easier, or more importantly, adding growth. And that's really what software is supposed to do, is help you grow your business without adding cost. That's what he was arguing. That's where AI should be deployed to, not trying to help a billing clerk, because there's very little value in that versus building actually real tools that improve workflows.
Yeah, and you can go down an entire rabbit hole with this, but I'm of the opinion that people overhired during COVID. So you see a lot of
overhiring.
Yes,
for sure.
So you see these people that are letting people go in masses, and they're blaming AI. I don't buy it.
I think it's because Wall Street rewards you. If you look at companies that have gone out, a couple of months ago, Square announced that they were eliminating 8,000 jobs.
Yep.
And people are like, oh, the AI job apocalypse is here. A lot of that, I think, if you look at it, Jack Dorsey, by the way, if you look at this from Twitter, Elon Musk sort of proved this. He got rid of 70% of the staff.
Yes.
And look, I'm a prolific Twitter user, now X user.
Yeah, I appreciate it.
It was very painful. For a couple of months there, things were breaking inside of the Twitter sphere. But then it works better now. But he's still 2/3 reduced on staff. I think they only have 100 engineers total.
Exactly.
This massive business, and they had something like 2,000 before. So I think the Elon Musk model of proving that you can be leaner is better. And to your point, I think it was an overhiring situation.
Yep.
Yeah, it's called AI washing, right? I mean, they talk about earnings have AI washing in them.
Yeah. Well, stocks are rewarded. It used to be when a company did a layoff that their stock would get beat because people are like, get beaten because there's a problem in the business. Now it's the exact opposite, is that companies, Wall Street investors are rewarding you for being efficient.
Exactly.
So what do you hope to do?
Yeah, what's next with RateSafe?
For sure. So with all of that said, I think it's a good segue into this question. And what I've learned in building tools at Vantage is that you have to prove value. AI makes it extremely easy for feature creep to happen, where it's so easy to build feature after feature. So you can get lost in that, and I've been victim to it too, and you really got to catch yourself. So with RateSafe, I'm fortunate to be in a position where we are a freight brokerage. We know a lot of really good owner operators, right? That I can then get this to a beta very quickly to then give to them to provide feedback to us on, does this add to my quality of life daily as an operator, as a truck driver, right? So to get that feedback to then know, are we going in the right direction with this? And at that point, I think it would be easier to then determine, do we turn this into a direct to driver SaaS product? Do we turn this into an integration to pre-existing applications that the drivers already work within? I think that's going to come in due time, but I'm a big advocate for proving value before you get too lost in the features that you build.
What is the timeline for that? So the idea is you can upload this to the App Store. By the way, because of the massive surge of apps, I know Julie knows this painfully, their timelines to approve is a lot longer than it used to be.
Of course.
But what is the timeline that you would like to see the app in a beta for your drivers?
Yeah, first, I'm a big fan of web applications because partly due to
you don't have to go through the Apple
timeline
ecosystem.
Yeah, so realistically, my plans are to get it into a beta within 2 months, right?
Okay.
To begin testing at that point, and then working with the Sonar team too to maybe enhance and identify some things that maybe I didn't see in that week-long hackathon, right? Where I could leverage Sonar's data more efficiently, right? So I'm really excited to work with
when you were
guys
showing
on
it,
that.
I remember coming up, I was like, hey, there's some other
Fuel,
indicators.
yeah.
Fuel was one of those. They have a whole set of fuel. Sean, tell us about the Sonar APIs. You guys were not a Sonar user before, is that right?
Oh, we are.
They
But
Vantages.
you are, but in terms of actually using the API, you had not used that before. Had you used it before?
I do use them for Vantage's software that I've built as well.
Oh, you had a leg
did you
up.
find it easy to use?
Yes, yeah. And your API portal is extremely easy to use, and that's one of the benefits of AI too, where I can say, hey, robot, go in here and I need you to scrub the API endpoints that we need, and then I create my own knowledge base for that to then turn around and build with.
Did it help that you had experience before using Sonar?
Of course, the timing was very beneficial for me because, like I talked about, this entire year I've been building software for Vantage. So whether or not that gave me an unfair advantage, I don't know, because I did wait because I didn't know if you guys were going to be checking like my GitHub commits on like timestamps and stuff like that. So I truly waited until the start date to begin this.
Good. Oh, good.
Yeah.
So you didn't cheat.
No, I did
No
not.
cheating.
I did not. No. So
Drivers will be suspicious that a broker didn't cheat.
no, that's fine. Yeah. No, that's fine. But no, I'm really looking forward to working with you guys more on the development of the app, and hopefully within, like I said, 2 months, I plan to start beta testing. Yeah.
That's amazing. I love that we had the opportunity to do this and see the different ideas. There were a lot of great submissions. We had 17 different parties that ended up submitting something.
It's great.
We thought what you were doing was solving a very specific problem, which is making it easy for drivers to pick the right load for them versus, this sort of, I think oftentimes it's all about rate, and oftentimes the best rate isn't the best load.
Yeah.
No, especially if it's going into a terrible market, right?
Into a terrible market.
Spot on their next load.
You can get a nice length of haul, but then you're going to Montana and you're stuck, or you're on a load for 5 days that pays you a lot, but then by the time you deal with all of that, I mean, there's a lot of reasons why you shouldn't take a load beyond price.
Of course. Yep.
So I would be remiss if I didn't ask you about the market right now and all of the noise and news. You don't have to comment on the C.H. Robinson lawsuit, but I'd love to hear what your general sense of the market is.
Yeah, well, it's certainly unnerving to see, and I heard in the first part of your show, and you've mentioned it before too, that really strikes a chord. It doesn't really matter, or at least it doesn't seemingly matter so much what you do on the front end. It ultimately falls down to what the jury is convinced of in any one of these cases, right? So we do our due diligence in carrier vetting, but it is certainly unnerving what's going on. But at the same time, we've we're a bootstrap company, right? We started from nothing. We've never financed growth or anything like that. We're very nose to the grindstone mentality. So throughout all of the noise, which this is just another noisy area of life in our industry right now, on top of AI, on top of everything else, where I look at it and we need to just keep doing the right job. I mentioned that good brokers should want drivers to make good decisions. That is the mentality, that we need to just put your head down, keep doing what we're doing. Of course, make improvements when we find out new information that can improve how we operate on a daily basis. But we really just put our best foot forward.
What do you think the biggest of all of the things that brokers are now having to consider and think about? What is the biggest change you think as an industry that we will see that comes from this?
I think you're going to see a lot of people that don't necessarily have their wits about them on how you should form relationships and the types of people that you should be working with. They're
Chasing
going
the
to
cheapest carrier.
correct. They're going to filter themselves out, and even on the shipper level, I see that on the shipper level too, where a lot of them are in very bad positions right now because they, it's not even necessarily their fault, because you look at the average tenure of an account manager at a freight brokerage or a transportation manager at a shipper. I believe it's somewhere in the ballpark of 2 years.
Yeah,
right?
they've not seen. We've talked about this almost every show,
right?
On how shippers, have never seen a carrier's market,
right?
And look, all of this is new to all of us. The whole regulatory market, these lawsuits, and the whole stuff. It's all brand new.
Yes.
And it requires a brand new playbook that none of us are familiar with.
Yeah.
And it just feels like this regulatory compliance thing is just going to continue.
Yeah, and you've got to be able to pivot on a dime and adjust the way that you. I hate the saying that's the way we've always done it. I was just talking to one of our account managers. We were in North Carolina on a customer visit, and we all were sitting down talking about how so many people, well, that's just the way we've always done it. You cannot have that approach in the way you vet carriers or in the AI space now too. Like, you've got to be able to pivot and adapt to the changes that are coming, because it's only going to speed up. Like, we're living in a very fast-paced world, and it's only going to get faster.
Well, Sean, thanks for flying in to Chattanooga. Send us some photos of your 182. You flew in on a Cessna 182.
Of course.
Definitely a good choice for our winner. I didn't know that your dad was a pilot.
Oh,
You're
yeah.
going to be taking the most important form of transportation, general aviation. But we'd love for you, as you get this out in market, come give us an update. Tell us what you learned, good, bad. We're going to go on the software journey and build in public here.
Yeah,
we're rooting for you.
Yeah, I'll come down whenever. Thank you very much.
Really
Appreciate
excited that we had the chance to bring in those. We want to thank all of our supporters, partners that were a part of this. We'll be right back.
In today's freight environment, every second of uptime matters. Of course, maintenance is inevitable, but large fleets cannot succeed on reactive fixes alone. That's why Love's Truck Care delivers smarter preventative maintenance. Love's understands that operational pressures demand a nationwide service network for better visibility, actionable intelligence, and consistent execution, all of which you protect your assets, reduce your total cost of ownership, and maximize your uptime. Maintenance is, of course, inevitable, but large fleets cannot succeed on reactive fixes alone. That's why Love's Truck Care delivers smarter preventative maintenance. Learn more.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D. To keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me, and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Welcome back to the second part of FreightWaves today. It has been a great show. It has been these headlines keep coming. I have so many questions I wish we could have asked.
Yeah.
We just ran out of time, unfortunately, for our first two guests. But we're going to keep the show rolling. We're going to talk last mile. On Friday, Eric Kulish, our reporter, talked about the housing market slowdown has impacted last mile, has created some sluggishness in terms of growth. The forecast for last mile has dropped a bit. Let's get into that with Jake Stein. He is the Vice President of Retail Growth at Burke. Burke is an API or an AI-enabled last mile platform. Jake, welcome to FreightWaves today.
Thank you so much for having me. Nice to meet you.
Yeah, nice to have you. Now, you were at Uber Direct, which is obviously a major player in the logistics industry. Tell us a little bit about what experience you took from Uber Direct and what you're doing right now in terms of last mile.
Absolutely. Uber Direct was a great place to learn about the entire ecosystem that drives, last mile delivery, whether it be same day or on demand or next day. An exceptional team, a really broad reach in terms of their supply globally, obviously with heavy presence in the US and Canada, and tons of retail, grocery, restaurant, pharmacy, you name it, already using that platform. But one of the things that I found was an opportunity really was generally in the retail space, most of the retailers don't have a single vendor or a single supplier. And even though Uber has a great reliability and great reach, there's always opportunity for there to be in creating competition and improving on your reliability and getting potentially better cost, greater coverage. And really the only way to do that is generally either by building infrastructure to allow that yourself by connecting to multiple providers, or working through a platform that already has access to tons and tons and tons of supply across the globe. And that's really where I decided to make the change, because I felt like I could help merchants do better in that last mile space by connecting to a platform that had the opportunity for them to fill the gaps.
Now, Jake, when we talk last mile, a lot of times in our world, we're talking to transportation companies, it's home delivery, it's furniture. But I think what you're talking about is the DoorDash, Instacart world of food delivery and grocery delivery. Is that the way we should be thinking about last mile in your world?
Well, I think the way you think about it includes that in my mind, right? So last mile is really anything getting to the customer, right? So it could be from a DC or from a hub or from a 3PL or from a store. So really that all is encompassed in last mile. And there are great gig providers for that, but you also have, of course, in-house fleets and national carriers and couriers, parcel providers. So really, all of that encompasses last mile in my mind.
So you talked a little bit earlier, you alluded to the benefits of having more than one partner or delivery provider when you get to scale. And you just mentioned that hybrid model. Can you walk us through what that looks like and the benefits of it?
Sure. It's essentially, instead of only calling on one provider to do your delivery, and they may still be your preferred provider, but you have lots of other options at the time that the delivery or shipment is being created. So that way, if there's no supply available, if that system for that provider is down, or if their performance has dropped, then you have the opportunity to tap into a broader network of providers. It challenges that initial provider to perform better, to potentially have better costs and be more flexible. And you get a chance to then connect via API to dozens and dozens of different providers based on wherever your delivery needs may be.
So then how does your customer or a retailer or a pharmacy or whoever it is that ultimately is decide which type of provider to go to, and how does your platform help with that?
I think a lot of it depends on what service levels they want to offer. And in today's environment, it's not just about the service levels they want to offer, it's likely the service levels they need to offer. Because just like how for any given retailer or even online marketplace, having strong selection is a huge conversion driver, so is having choice in delivery. So it's not just having 5-day shipping or next day shipping, but also having the ability perhaps to get it same day by the end of the day, or on demand, or over a very specific 2-hour window because it's a high value item that might need proof of delivery or a signature or even a PIN code at arrival. So I think it's not just about which carrier, it's really about, or which platform, it's really about the SLA that they want to provide. And that gets complicated because you may want to orchestrate more across more than just the gig providers. You have your own fleet, you have carriers, and that you also want to be able to orchestrate across. And you need a system that can really spend the time in analyzing, okay, I'm going to offer these SLAs, and it's going to come from this choice of nodes. And then you need to decide which mode you want to go on, and you need the AI intelligence to help you do that.
So I want to talk a little bit about some of the cost and profitability pressures. Certainly retail, grocery are seeing those in their own business. And then when you add in delivery and all of the things that Walmart has done, I imagine cost pressures, and which I have said it publicly before, my household.
You're a big Walmart.
I mean, like my.
What do they call that?
Whether
Last
it's
mile? What's the?
I use the Walmart Plus.
Walmart Plus,
I mean, like
right.
my household would, if I'm being honest, I've set up.
Would not
fall.
operate?
It would not operate without it. We get our groceries delivered every week. There's always something that I've forgotten that I need, like in an hour. The kids have to have for school the next day. But that being said, I imagine it creates cost pressures for others, and certainly when it comes to delivery and retail and groceries and all of that. So what are you seeing there? Where are the cost pressures coming from? How is that affecting delivery? And what does that look like from a margin pressure percentage?
Absolutely. I mean, whether it's Walmart Plus or the, Amazonization of, consumer demand, expectations are really high. But I don't think the expectations are remaining just on improved speed. The expectations are shifting a bit more towards, or a lot more towards, reliability. And I think that's where, yes, there's cost pressure primarily on the speed side, but if a customer is willing to have, let's say, a 2-day delivery window, or a 2-day promise, as long as it's coming when they say the provider or the merchant says it's going to come, that is generally a place where customers prefer. Price is always going to be number one in the delivery choices, but it's shifted. Even McKinsey stated in reports that, it used to be, price then speed. Now speed is down about number 5, and reliability or accuracy of the delivery is number 2 after price. So
that
I
changed
think
with COVID, where people had to change their expectations?
I think that's just during COVID, obviously, is when all of this exploded. And because the demand for speed was so high, it wasn't easy to do super well, right? And there's only so much supply out there. So if you're paying a lot for a specific speed delivery and it doesn't go well, you're a lot more disappointed than if it's perhaps free and doesn't go well. So I think as that has left somewhat of a taste in consumers' mouths that I might be paying for speed, but I might not always get it, that reliability starts to creep in, or that lack of reliability starts to creep in more, where customers are willing to say, I know when I'm going to get it, instead of having to pay for speed that I may not necessarily get.
I mean, it makes sense. Same day delivery or within the next couple of hours it's a choice between, do I go to the store? Do I have the time? If you're a busy mom, like Julia's, you're like, I need this in the next couple of hours. My kids' assignments in the morning, or
Do I want to
dinner.
put shoes on and get in the car?
Yeah. Do I want to? I have other things I need to do. We keep you busy here, and the question is, that's where reliability's there. I would rather know, like you said, if it's 2-day, I can sort of tolerate that it's going to come between a window sometime today. But if it's same day, if it's a food delivery or a grocery delivery, you need it then. That's frankly, most people order the groceries or food at the last minute. So,
and I think that buying experience is different for the same customer depending on what's going on, right?
100%.
Like you mentioned, right? So that's why, as I mentioned earlier, I think the delivery choice is pretty critical, because we should give them the choice of what they want, because it might be that they need it now, or it might be, and they're willing to pay $15 to get it in the next 2 hours, or it might be that they're fine getting it in 2 days as long as it actually comes.
Yeah, I needed some batteries this weekend, and I just didn't have. It was like one of those really weird batteries, and I needed it right then. And I was with my younger children and didn't want to pack them up and go to Walmart to do it, because I inevitably, frankly,
and you're going to spend $300 on whatever other random stuff you want.
That's the point.
Yes.
You take the kids to Walmart, they want to hit the toy aisle. I'll pay the $15 delivery.
I took mine to Target on Saturday as a mistake,
because it's cheaper than what my kids would drag out of the store, and I didn't want to deal with the meltdowns.
Yeah,
and if
but I think that you're right. The option, right? Am I okay to get it in a 2-hour window tomorrow? Am I going to pay a little bit to get it in 3 hours and pay a little bit more to get it in an hour?
I mean, the convenience is there. Sorry, Jake, what were you saying?
I was just going to say, and if the retailer doesn't offer all of those particular shipping options in that particular buying experience, they're going to go somewhere else.
Well, it's all top of wallet, top of delivery. If I'm starting to get, it's one of I think Amazon's big advantage. I was talking to a retailer in aviation, Sporty's, which is like the number one retailer in general aviation. I was having this conversation with their president this past weekend at Oshkosh. I'm a pilot. I buy a lot of stuff from Sporty's. It has everything I'd ever want. The problem is occasionally I'm like, hey, I need something. I'll just go to Amazon, because it's already delivering to my house and it's easy, and it's in I can buy 15 things there. And so
add to Wednesday's delivery.
It's a disadvantage.
Add to Wednesday's delivery.
It is. It's a disadvantage for these smaller boutique retailers competing against the majors, because if you're already buying things, you're like, I'm just going to go ahead and add it.
So if a retailer is thinking about, all right, I need to rethink my delivery strategy for some of these reasons, where should they start? What should they do?
I think they're going to have to look first to what your customers are telling them, right? I mean, what is it? Has there been a change in behavior with what they're currently offering? Are they people buying less standard shipping and buying more increased speed, or is it the opposite? So I think that's important, but really getting the data is super critical, and having a layer in your system that can read all of those signals. What is the consumer clicking on in your page in terms of, are they going deep into the shipping options section? Are they abandoning the cart because they only see standard shipping or maybe next day shipping, but they want something faster, or vice versa? You need to start with getting an understanding of the data, and really that's as simple as having a platform that can read it, right, and tell you back, okay, this customer abandoned the cart because you didn't have X. if you had X, perhaps that customer would have converted. And then you could start offering that hopefully on your e-com or your app, and then follow the data.
All right, Jay, I got to ask one last question before we go. We could spend the next 30 minutes talking to you, but we can't do that. But drones and autonomous delivery, where are we at in that cycle? I know there's been some tests, Zipline.
There's a lot of tests going on. And I think that there's absolutely space for it. It's going to take time. There's a lot of obviously regulatory rules that are apply in airspace control and things like that. There's going to be a lot of space for speed and honestly, a huge space for cost. Right? I mean, as they start to become more, commoditized, it's a lot cheaper to drop off, prescription in your backyard than to have somebody deliver it. I definitely think there's space. The autonomous delivery vehicles is going to be tougher. Yes, you probably have some experience with them today where you still have to go out and get it out of the vehicle, but that's not what the convenience that a lot of people are paying for. They just want it right on their doorstep. So There needs to be a bridge, and there's companies looking at that. I think that'll take longer. But drones, it's going to happen. It's just going to take a little bit of time.
Well, Jake, we're going to have you back to talk about that. That's a totally different, deep conversation. Thank you so much for coming in and joining us today on FreightWaves Today. We'll be right back after these messages. We're going to talk about why this recovery isn't what it seems with Blake Ezell. He's the Vice President of Customer Success and Support in Teletrans. He's going to talk about the freight market. Right back.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
Welcome back to FreightWaves Today. We have Blake Ezell. He's the Vice President of Customer Success and Support in Teletrans. Blake, welcome to FreightWaves Today. Your comment or your theory on this, you have argued that this is not as the same recovery freight market that everyone's talking about. What is your sort of view of the market right now?
Yeah, good afternoon. Essentially, I think everyone has assumed for many years that a healthy market, is a tight market with high prices essentially leads to a healthy market. And, I don't think that's the case today as we look at, as I talk with many shippers and what they're experiencing, there's a big gap between what's going on and some of the key market indices.
Now, for those that aren't familiar with IntelliTrans, you're part of Roper Technologies. DAT is a sister company. We compete with DAT. We love to hate them here at FreightWaves today, but we'll let you off the hook there. But you guys are a TMS really for the bulk and break bulk market, which is different than a lot of our core audience. When we look at the bulk rate data, which we have inside of Sonar, it hasn't seen the same volume increases and high rates that you see in some of the over the road market. Why is the bulk market not as vibrant, we'll say, as the overall truckload market?
Sure. Well, I think if we look at 2026 at the freight market, it's just genuinely tight, right? So we know we've got a number of different industries that are either at historic extremes, at all-time records, or even rates. We're still seeing rates from 2021. The issue becomes the volumes, and we're looking at softened volumes from about 2023. And so what we're trying to understand is why is it that, what's really driving, why do we have, say, on the bulk and break bulk side, a flatbed index of 73 to 1, load to truck ratio? Why is that happening, and what's really driving it? When we look at the volumes, we look at a softened market of, call it 4%, volume erosion.
What is in your customer base, what are customers thinking about right now? I mean, if the market volume isn't as robust as perhaps just the overall capacity situation, what are they doing to navigate this?
Yeah, good question. So now we're in the bulk and break bulk space. So think chemicals, plastics, forest products, building materials, metals, mining, et cetera, et cetera. It really is what's going on in the market, what are there structural changes that's happening, but where is the capacity going, right? Where's the capacity going, and why are those rates going up? I think a few things to look at. We've got a serious kind of a paradox, right? So like I said, we're essentially paying premium pricing for softened volumes. And that's being driven by a few things. So going back to, roughly around 2020, we started seeing erosion in driver availability. And I think this is a key piece to it. But then there's also what I would say you've got driver erosion outside of retirement. You've got cash flow economics right now, especially when we look at fuel surcharges and the impacts of that on independent carriers. And we see a lot of that within the flatbed markets, the specialized asset market. And then at the same time, there's also kind of a silent competitor that has come into play now that appears to be absorbing a lot of that capacity at different margins than what these commodity shippers have been able to withstand.
What is you say silent competitor, what do you mean by that?
Yeah, so, AI, obviously AI, it's the big boom everyone wants to talk about, right? So cloud computing, but behind cloud computing it's the data centers, right? It's large data centers, and it's all the freight that moves into those data centers. Those aren't moving typically in a van, right? I mean, it's going to be on your flatbed freight and specialized. So that data center world really is, I think I've seen numbers as much as, roughly worth, at this point around 83 billion, projected to grow into about 150 billion over the next 5 years. All of that demand from that data center growth, that's where I believe we're starting to see the capacity moving from our traditional freight markets, moving that in that direction.
Yeah, I mean, I think there's no question about that. We've talked a lot about the freight needs and the amount of freight that the AI construction and data center boom has created. Craig could quote the stats better than I can.
7% of flatbed. I mean, we've got this.
They're spending every 5 weeks, the same amount as we
No,
spend
it's every
annually?
2 weeks.
Okay.
700 billion. So the interstate highway system was 20 billion a year over 35 years. The hyperscalers are spending that every 2 weeks to build out data centers. Most of that, or over half of that, is going by flatbed. And it's not obvious to people. People are like, well, GPUs. No, we're talking about concrete, steel, PVC pipe, generators, transmission, copper, fiber optics.
Sure.
Steel, all of that has to move to build out an AI data centers. 30,000 truckloads, Julie, to build a 500 megawatt data center. And now there's an announcement, not too long ago, of a 10 gigawatt, which is 20 times the size in Utah data center that Kevin O'Leary is trying to put up. The numbers are astounding.
So I want to make sure
Yes.
I understand sort of your thesis here about what makes a healthy freight market in the situation we're in. So I think there's no question we've all felt like this cycle has been driven by lack of capacity, not by increased demand. However, there has been new demand specifically for flatbed coming out of these AI data centers. And then when we track the bulk and the other commodities, many of which you mentioned in the rail numbers each week, we have seen gradual
Surge in
increase in
volumes.
surge in volumes in all of those. So I want to understand where you feel like the pressure is and what you think is the most imbalanced part of our freight market currently.
Well, so if we look kind of on the rail side, we've seen marginal volume increases year over year. Chemicals, forest product, non-metallic minerals, motor vehicles, all basically flat to, a deterioration. We've really seen, so if we look at kind of the key pieces of business that we would anticipate moving within the data centers, that's where we've seen the growth. We've seen, it's essentially, we're seeing this digital capacity. The digital world is creating call it a parking lot so much within our physical assets for the supply chain that's moving flatbed. Again, we've seen roughly, I think it's 4% volume decline, right? So 16% tender rejections. We know the markets are soft within the key typical commodity segments. It's soft. Volumes are increasing, and it's our shippers, our commodity shippers are now almost getting into a bidding war with the tech giants, right? And so that's really where the concern is. Craig, like you said, they're moving just about everything in from HVAC to wire to concrete to structural steel. Everything is moving into these markets, and for logistics managers, it's what can they do? How can they best position themselves moving forward? Because for the next foreseeable future, unless there are structural changes within the data center environments and regulation, then we would infer that those markets will continue to stay very tight for the near future.
Blake, it's not going away. We did a long form we call SITREP, which is a deep dive into AI data centers. Only 8%. This is when we did it a couple months ago. 8% of the data center announcements that have been announced and contracted are under any level of construction. And so if you look at this chart that we got pulled up in terms of the amount of truckloads, by the way, this is truckloads. And the good rule of thumb is 50 to 70% of that number, depends on how you classify it, is in the flatbed, open dimensional markets. Some of it is in bulk because your concrete moves in bulk, gravel moves in bulk. We're talking about this being a multi-year, even with some of the data centers delayed or, states and cities and municipalities doing moratoriums on data centers. It's not going away.
Well,
and so this is going to be something that's going to be around. I mean, look at the fact we're at 3 million truckloads this year, and we're ramping to, just every single year is an increase. And it would be foolish to think that AI data center construction is somehow going to go away. These are, by the way, public, a lot of people like to compare the dot-com fallacy and the dot-com days is like this is a bubble. Maybe it is, but these companies that are investing CapEx are the most profitable, operational cash flowing companies on the planet in the history of mankind. They're not going anywhere. And this is not only the race to build AI, you also have competition with China, you have competition with Europe, you have competition with the Middle East. I mean, Saudi Arabia is going to invest hundreds of billions of dollars in, they had this massive line across the desert city. They've turned it into a massive data center because they're like, that's a lot more interesting to us. This is not going to go away. The Department of Defense, a big part of their budget is towards data centers. So I would argue that this is a permanent structural change in our economy.
No, absolutely. The irony is it's AI and cloud computing that is what is creating it. And it's meant, for all intent, to make us more efficient, to get us information faster, to save cost, et cetera, et cetera. But at the heart of this, it's also driving the problem that is making everything else more expensive when we look at the markets that these other commodities actually support. Our food, our housing, it's all getting more expensive, and AI is somewhat at the heart of that.
Yeah, construction workers, if you're building homes, and one of the things that isn't being talked about is construction workers are going to these AI data centers. And the AI data center customers, the hyperscalers, are price insensitive. They do not care about what normally you have a very rational market with traditional shippers in our world are very sensitive to small changes in price because capital markets, because the stock market has rewarded them so kindly with massive surge in stock price. They're price insensitive. They don't care that the price went up by 10% to build out the AI data center. And I think that's one of the big impacts. I mean, the amount of energy and power that these AI data centers are consuming is, power consumption went up very linear over the last couple of decades. This is an exponential growth in terms of power demand. And yes, you can argue that the AI data centers are a big cause of that. The biggest cause of it is that we didn't build power centers, utilities, or pipelines across the United States, or transmission lines. We were stunting in terms of, we just underinvested. And I think we're having to play catch up to that, Blake.
That's right. And I think we're starting to see now, a resurgence in coal growth as well, moving across and powering these facilities.
So what are shippers doing about this? I mean, this is something they're going to have to live with. How do they handle it?
Yeah, so there's really, three things that I always think about. The first is to be, so this is what I would say, this is a capacity tax, right? So it's supply constrained. It's not a tax that's because, hey, the market is good and rates are up because people are buying and companies are selling more, people are buying. That's not the case. Rates are up because, just overall supply is tight. There's fewer drivers. We've had again, through driver enforcement, we've lost drivers, about 250,000 drivers since 2020. We've lost drivers due to retirement. But we've definitely, this is a capacity tax that they're paying in order to move the freight. So understanding that tax. The first thing, don't rely on those headline indices. Stop using, completely discard the national averages. It's no longer applicable. Look at your specific lanes, look at your regional averages, understanding your market and your freight type, but definitely discard the national average. Have conversations with the carriers. Unfortunately, rates and contracts negotiated a year ago, they may be signed on paper. You need to make sure that those rates still support the capacity commitments, right? So we know carriers, especially the small independent carriers, they're bleeding OpEx. Fuel surcharges, that's hurting. That's hurting in this environment. But they are, dispatchers and the carriers. They're definitely being selective with freight. So make sure that your current rates and rates coming up in the future, those support those capacity commitments, and then build out a tiered backup plan, carrier backup plan. The third opportunity.
Go ahead.
I'd say the third opportunity is really to evaluate modal arbitrage. We still have rail transportation still offers a compelling opportunity when you look at transloads. But understand that by lane where you have opportunities. But rail rates are up roughly 2%, capacity utilization sitting around 70%. So rail still is a very cost advantageous opportunity. It's just a matter of going through the exercise and understanding where you can move through transload systems.
Well, Blake,
and then fourth, it's kind of the final piece of it, Craig, is really it gets back to AI. Everybody's talking about AI and how they're going to use it into their business. So AI is kind of the lead in this, but it's also the laggard because it's causing the problem. But as the shippers are looking at the various AI opportunities and technology that's moving towards them and being offered to them, really understanding where their data is and what state the data is, and understanding that data strategy, because in this market, data is going to be everything, and it truly is. I think it's the race to the underlying data to help with this problem, and it's not the race to the AI algorithm.
Yeah, well, Blake, so thanks for coming in. Great points on rail, and particularly you see it in the intermodal market, but bulk is also really attractive, and we're going to get into that tomorrow. We have the Future of Rail Symposium here, broadcast from Chattanooga. We've got a fantastic lineup of CEOs of the largest railroads and most important players there. So we're going to talk about all of this and the attractiveness of rail. I mean, we've covered the rail market. We do every Wednesday when we get the AAR report. It's rocking. Yeah.
And the rates aren't up. The volumes are up.
Volumes up. Intermodal has not. It's been so slow. I think
yeah.
it's a market share game. I think we're at 32% spread between truckload and intermodal. So, Blake, thanks for coming in. Julie, I got to ask, just thinking about all this, at the end of the day, do we care that an AI data center is, if we believe this is and I do, if this is going to last for many years, that's now part of the economy. It's a new development, but it's a permanent fixture.
I mean, maybe I should, but no, I think it's great. I mean, does that mean that we probably need to figure out where some more flatbed capacity comes from? But to me, anytime a new sector that can generate this amount of freight, can generate new revenue for our economy, can generate more optionality for those construction workers, right? Where they can...
More jobs.
Yeah. So yes, maybe that's a problem if you're building houses, but these guys now have equity, better pay, and for longer time. Right?
I think there's two arguments here. One is that the amount of capital is helping build construction jobs, people who need it, the blue collar. Everyone's talking about the jobs apocalypse and the fact that we may see jobs go away because of AI, but clearly this is doing the opposite. I mean, the employment numbers are actually quite robust. So it's not having that impact, maybe in certain circles. As we talked earlier on the show, is that a lot of the AI washing, it's like, oh, we're AI, we're going to eliminate jobs because of AI. A lot of times it's just companies correcting course on how they operate their business. Yep. So look, I think it's interesting. That conversation itself is interesting. I want to talk before we close, because we've only got a minute here. Who are the winners and losers in this post-Montgomery segment? Who do you think wins?
So I think providers who are helping with carrier vetting, software providers, tech provider, whoever.
Like a highway, companies like that.
Helping with carrier vetting, helping with safety. I think those who provide safety software or safety hardware solutions for trucks are winning.
So a company like a Samsara, who's a sponsor of our show, the headline sponsor.
And I think big carriers.
Big carriers definitely win, because they're already doing the work of vetting drivers. They have to. They've always had targets on their back. It's interesting because we've talked about brokers. The jury's out, in my opinion, on how the big brokers, obviously C.H. Robinson is the biggest, and
I thought they would fare better than the medium size, right? But
that has been the argument, that the larger brokers were better. That's an argument that I've been talking about.
Prior to this verdict, that was my thought as well. But now I'm thinking big pockets, big
pockets
target.
Means big targets. So I don't know. It's interesting. It is. Do we reach the point where, and I think we can see this, where the brokers and the shippers are going to start mandating like driver-facing cameras? I can see the day where they realize, hey, I may have to go litigate this. The carrier is not going to fit the major part of the bill. Do we see a day where there is some mandate?
Forward-facing, certainly. In-cab facing, that's going to be harder. Forward-facing, yeah, you need that for litigation. You need to see if potentially the other party was at risk or was
brokers may mandate that. It puts Samsara and any safety technology in particularly a great position. Well, that was a great show. We'll be back tomorrow. We're going to talk rail all day tomorrow, so stay with us. Come back. We kick off things with the CEOs of UP and NS, and obviously the biggest story is the transcontinental merger. We have the STB, who is the primary regulator, and we just have a jam-packed list of thought leaders across the rail market. That is tomorrow for our Future of Rail Symposium. We'll see you then.